Good afternoon, everybody, and welcome to this edition of Australian Broker Moves Review for January 22. My name is Carl Capolingua. I'm the market analyst over here at Think Markets, and it is a pleasure to be with you as we wade through quite a big week, actually, in broker moves. We are getting very, very close to Australian earnings season, first half earnings season, and we've had a bunch of companies out just guiding investors as to what to expect, and as a result, brokers then need to do some research. And we get the broker updates. We'll talk about that and more after we talk about the Think Markets difference, which is substantial. $8 flat rate trades, your own holder identification number, unlimited phone support, no platform fees or subscription fees. And if you can switch to us before Jan 31, 10 free trades as well. So 14 fantastic reasons why you should make sure your next ASX share trade is with Think Markets. The agenda for today is to check out all of the broker upgrades and downgrades from during the week and their profit target increases and decreases, and then we'll have a look at a few stocks of interest as well. Let's kick off by looking at the upgrades for the week. So each broker has a rating, buy, hold, sell, somewhere in between or outside of as well. And that's what we're looking at here. So changes in those ratings. They also have a price target, and we'll talk about that in a little while. But looking for themes on this page, I can see a few property trusts. So UBS has increased their rating for Charter Hall Group, Centuria REIT, and Stockland from neutral to buy. Citigroup has covered the healthcare sector. So we can see Cochlear, CSL, Ramsay Healthcare all getting upgrades. Cochlear from sell to neutral, but a nice increase in the price target there from 184 to 200. CSL has gone from neutral to buy, but I do note a small dip in the price target from 320 to 310, and Ramsay Healthcare from neutral to buy, and from memory I think that one is at about $72 and steady. Apart from that, we do note National Australia Bank going from underweight to equal weight at Morgan Stanley. Computershare getting a nice one from neutral to outperform. Ansell from underperform to neutral. We'll talk a bit more about Ansell later on in the presentation. And Domino's from neutral to outperform. As with any of these pages that we'll go through today, lots of information, so feel free to press pause and see if a stock that you're interested in is in there. Having a look at the downgrades, and the first time in recent memory, really, that we've seen more downgrades than upgrades. So that's a little bit interesting in itself. In terms of what's in here, Clean Away Waste Management getting a couple from outperform to neutral from Credit Suisse and Macquarie. No major themes there. National Australia Bank buy to hold and Bendigo neutral to sell. It's a bit of a mixed bag for the banks. HiFi came out with a sales update during the week going from outperform to neutral, but brokers generally quite positive on that one, as we'll see. Otherwise, we did see Goodman Group going from outperform to neutral. That has been a pretty high flyer, and a 5% decrease in the price target from Macquarie, so that's quite interesting too. Okay, have a look at the price target increases. Lots of these. Ansell coming out during the week with an update for their first half profits, and just looking at my notes here, so we're going to see organic growth north of 20%, the company said. The earnings per share for the half should be in the range of 81 to 84 cents, and that represents 62 to 68% growth on the previous corresponding period. Now they're expecting full year earnings per share growth to be well above the 135 to 145 previously guided in October. So we can see a couple of price target increases there from Citigroup and Credit Suisse. Small changes, but still plenty of room to go between where the current price is and the broker's targets. Other than that, we'll see a few banks on this list. So Morgan Stanley increasing their price target from ANZ by close to 20%, still about 6% upside in there. BHP came out with their quarterly production report, largely in line with the expectations. So we saw a bump up of about 8% from UBS, but it was a bit mixed bag in terms of how brokers viewed that one. We have seen a bunch of price target increases in the lead up to this report. BlueScope getting a small one. Let's look for the bigger ones in here. So City Chic Collective, 26% increase from Morgan Stanley, and still about 14% upside seen there. Challenger, this is interesting, 54% increase in the price target, but that is actually 2.8% above where the current share price is. Coronado, a couple of nice bumps up and some good gains still seen in that stock. Macquarie and UBS, the brokers on that one. Again, looking down the list for the key ones, Citigroup 21% increase at Michael Hill, still about 15% upside seen there. Still some nice upside seen on Megaport from UBS and Cytec Pivot, still looking like plenty of upside at Morgan Stanley, and Mirvac Group looks like about 16% upside at Citigroup. Nice to see Nickel Mines stock we follow very closely here at Think Markets, 140 up to 150 at Macquarie, and that's still about 15% upside. Northern Star Resources about the same. Having a look into the next page now, Net Wealth Group also had a bit of a profit guidance out, so brokers active on those, but looking fairly fully valued there in comparison to some of the other ones we've discussed. Premier Investments, nice bump up from Macquarie, still plenty of upside seen on that one, and South 32, small bump up, but still plenty of upside there. Into the next page, a few energy stocks actually featuring this week. We'll see Santos here, but looking fully valued based upon the brokers' price targets, even though those price targets did rise. We'll see Woodside on the next page, but first let's look at Super Retail, which picked up 6 profit target upgrades of varying magnitudes, fairly modest upgrades, but plenty of upside still seen in the share price. And we'll talk about Super Retail and its profit guidance that it gave to the market in more detail a little later in this presentation. As I said, banks or brokers fairly active on banks this week, so Citigroup and Morgan Stanley increasing their price targets for Suncorp. Cenex Energy is a small bump up, but still plenty of upside seen on that one at Citigroup, and that's a big upside, isn't it, for Whitehaven Coal from Citigroup, 115% to their price target. If I'm not mistaken, they are the most bullish on that company by a long way. And into the final page, I did say Woodside getting a few updates here, and nice updates, but fortunately the share price looking a bit fully valued compared to that. And I'm not sure what's going on there. That might be a typo, but there was about a 6% increase at Macquarie Group for Zip, the buy now, pay later stock. Once again, pause whenever you need to see if your stock's on the list. We'll have a look at the decreases. We'll do this quite quickly. That's a big one there, isn't it? So Appen, 37% decrease to $27 from Macquarie, but they do maintain an outperform on the stock, so that is encouraging. Other than that, they're pretty modest pullbacks in prices. Tyro Payments, now we know that company's had a bunch of problems with their payment systems, the hardware in various retailers, and there is talk obviously of some legal action against them, so a big price target drop there from Macquarie from 350 to 250, and there's still downside seen from there. Resolute, we did get some decreases in targets, but still plenty of upside potential. Okay, Ansell, as I indicated earlier on, some great numbers from them. Of course, we know what Ansell does. They do gloves amongst other sort of protective equipment. PPE is the official name given to it in the COVID pandemic, personal protective equipment. And we'll have a look at what the brokers have to say on this one. So we did see Citigroup raise their price target slightly, but they do like this one. It's a buy, and they did like those earnings guidance numbers. It was way ahead of their estimate. So we talked about this 81 to 84 cent range that the company gave, and that gives you an idea of where the brokers were at. So a big upgrade, and they see further upside in FY21 earnings. Credit Suisse increased their price target slightly, but retaining an outperform rating. Better than expected guidance. They increased their FY21 earnings by 19% on continued demand for PPE as the pandemic drags on. Macquarie upgraded their rating from underperform to neutral. They raised their price target quite nicely, actually 33.35 to 36.35. They noted strong demand across all divisions for Ansell, and margins were also improving. That's very good. UBS lowered their price target, so bucking the trend there a little, maintaining a neutral rating. They were pleased with the trading update. They said organic growth was strong, but there could be some negative impact from the Australian dollar or the strength thereof. But they did increase their expected earnings by 4%. If we look at the consensus for the stock, we have an average of a hold, 1 strong buy, 4 buys, 4 holds, 2 sells, no strong sells. The average price or average target price for Ansell is up around here, around 39.40, indicating a little bit of upside from where we are right now, but the high estimate of 45.50 is pretty good. In terms of the fundamentals, the stock you wouldn't say is overwhelmingly cheap at a P of 19.2, but the market PE is about 20, so it's a little bit cheaper than the broader market. The PEG ratio is disappointing. We'd like to see that closer to, or ideally below 1. Dividend yields, not shooting the lights out, 2%. Enterprise value to revenue is very, very good, though. That would probably put it in the top 10 or 15% of stocks on the ASX, is my guess. Return on invested capital, not too shabby at 11.5%. So fairly robust fundamentals there, but not shooting the lights out, and maybe reflective of that hold rating and some of the valuations that we've seen. JB HiFi, well, they came out during the week also and gave some guidance on what their sales are looking like, and we saw 25 to 30% growth in sales. The big highlight was their online sales. Just looking at my notes here, up 161.7%, and I think there's a stat in here that now represents about 44% of their sales. And online, it's a very efficient way for any business to sell anything, because you don't have those huge overheads associated with it. So that is a good thing for JB HiFi. As a result of those numbers, Citigroup raised their price target from 50 to 53, retained a neutral rating. That's the word there. It's a boom year for JB HiFi and some of these other retailers. But there's a bit of talk out there, a few questions as to whether the sales momentum is likely to be sustainable in the long term. Obviously, we're seeing a lot of spending getting diverted from overseas travel, even what would have been domestic travel, into consumer discretionary spending. So gadgets, TVs, everything JB Hi-Fi sells, and home improvement and the like. So is it sustainable, this bump in sales, or is it going to peter out at some stage? Look, I think much of it is going to stick. Because there's going to be an extended period before we can go back to normal travel movements, given what's going on in the world, and that is despite vaccine rollouts. So let's have a look at some of these brokers very quickly. Credit Suisse, they downgraded their rating from outperform to neutral, but increased their price target from 53 to 54. Look, it was a downgrade, but they said they were pleased with the sales update. They said there was strong sales momentum and expanding margins, scope for further gains. And I guess this is the reason for their downgrade, isn't it? The share price appreciation has forced the rating change. So they're saying, look, it's had a bit of a rally recently, and that's causing us to not see as much value in it as we perhaps did a few months ago. Jefferies increased their price target, nice bump up there from 46 to 50. They said there's little sign that this short-term sales momentum is going to let up. I've talked about travel budgets. They continue to be redirected towards discretionary retail. Maybe the second half we might see a bit of a slowdown. Macquarie Group, they like it, 49.50 to 53.10, retained a neutral rating. Strong sales momentum is in line with the brokers' expectations. Harvey Norman is their preferred pick in the sector. However, UBS, they said 47.80 to 51 for their price target, retained a neutral rating. The sales numbers look strong, impressed with online sales performance. As I said, now 44% of sales. The continued strength in retail spending, and the company's ideally placed to take advantage, but notes that share price appreciation undermines the valuation opportunity. And I think that's reflected in some of these broker ratings over here. So we've got an average of holds, 1 strong buy, no buys, 10 holds. Broker's fairly neutral on this one, 1 sell. The mean target is 51.60, which is basically bang on where it is right now, probably hence the holds. High estimate of 61 gives you a little bit of upside. In terms of the fundamentals, look, it's way, way cheaper than the ASX 200's PE of around about 20. That's impressive in itself. So it doesn't look expensive. Its growth is pretty good. Again, we'd like to see it sort of below 1, but we're getting a lot closer, certainly closer than Ansell. Enterprise value to revenue is outstanding. I would reckon that's the top 2% of all companies. And your return on invested capital is extraordinary because of this online sales component here is growing, and that should stay that way. So look, it is a very impressive company. Would I buy it here? Look, I'd be happy to buy it here, despite, I guess, what these brokers are saying. Stronger for longer is definitely my opinion, and I think from a technical perspective, charting perspective, it looks very, very strong. If you're a little bit conservative, wait for a dip, you might get it below $50, but I think it's still pretty good value there based upon these numbers. Certainly if you've got it, you would absolutely hang on to it. There's another company I think you would very happily hang on to, Super Retail Group. So this is the auto parts retailer. And they came out with some great numbers as well. They're expecting to almost triple net profit after tax for FY21 now. They're just doing so well. Citigroup raised their price target from $13.10 to $14, retained the buy rating. They said that the retailer will likely outperform their peers over the next 6 months, increase their FY22 expected earnings by 11%. We've got Credit Suisse going from $12.21 to $13.19 and an outperform rating. They said that the first half update was good, confident their sales momentum can be maintained into FY22. So compare that to, say, JB Hi-Fi, where they were a little bit less certain. And compared to JB Hi-Fi, we're seeing here that the valuation remains attractive and continued re-ratings are likely. Macquarie raises their price target from $11.30 to $11.70. They're neutral on it. They said that the first half trading update was better than expected. Some gains are going to be permanent, much like I think we're going to see some of that spending stick, and that's going to help these companies going forward. Margins are improving, and we're seeing that consistently across these retailers because they've almost completely stopped discounting because we're in a frenzy to buy and they don't have to discount as much, so it's helping their margins. Morgan Stanley raised their price target from $12.30 to $12.90. They were impressed with the first half trading update. Earnings forecasts were better than expected. Another one from Morgan Stanley might be just a copy of the same update. They increased their earnings expectations by 40% for FY21, massive, and 24% for FY22. And then UBS increased from $12.20 to $12.60 for their price target, maintained the buy rating, reacts positively to what it describes as a solid first half sales performance. Tailwinds remain, and the group is well placed to take advantage. Margin improvement very impressive. And we're seeing that impressive view of Super Retail Group reflected in the average ratings. So we've got two strong buys, I should say, 6 buys and 3 holds, no sells, no strong sells for an average of a buy. The mean estimate is $12.89, which gives you a nice little bit of upside there, but the high is $14.80. In terms of the fundamentals, and I think this is really where Super Retail starts to shine. So the PE is 10. Now that is half of the market PE. So it's twice as good value as really the market on average. Its PEG is below that one level that we're looking at. It is fantastic at 0.72. Enterprise value to revenue is off the charts at 1.05, and return on invested capital also very, very solid as well. Dividend yield of 6.2% makes this one, a screaming buy for me. The chart looks good. It's not quite bottom left, top right because of obviously what happened with COVID, but since then it certainly has been. And there's nothing in the chart that suggests to me this run can't continue. A little bit of a pullback over the last few days, so I think you're getting it at a small discount, and buying around here I think is suitable. Okay, well, that's it for today's session, but hey, there's plenty more information available on the website. Head to the market analysis section from the homepage and you'll find the market news area, and also you'll find our webinars as well, and you click on that and you'll be presented with all the webinars you can register for. You must register for these to be able to have access. So we've got our weekly think tank on Monday. That's our wrap up of the week that was and look to the week ahead. And then on Wednesday we'll have an introduction to technical analysis where I'll teach you how to look at charts. Ask the experts exactly 1 week later, when you can literally ask me about your entire portfolio if you like, and I'll do a quick fundamental and technical on the stocks you have, and then we'll do how to create an investment plan on the 10th of Feb. Now, I did use quite a bit of jargon today when we were looking at those stocks of interest. We talked about enterprise value to revenue, we talked about PEGs, price to earnings ratios, etc., etc. Now, there is a really good webinar on exactly that in the market news section. Just do a little search. You can search for my articles, use the filters there, special report, and you'll find that. It's how to value a stock. And I'll show you exactly how to use those ratios, how to calculate those ratios for each stock, where to get the information from, and then how to use them to determine whether you're getting a good deal or not. So, not just ideas on what to trade, but plenty of education as well from us at Think Markets to make you the best investor you can be. Hey, but before you go off and do all of that, read this disclaimer carefully. Everything we've talked about today is general in nature. Hey, we are a regulated Australian broker. We do have some products that could see you lose more than you deposit. So read this disclaimer carefully. Give us a call or consult the website if you've got any questions at all. That's it for me today. Hopefully you enjoyed it. All the best for your trading. Until we catch up again. Bye-bye for now.